deeply experienced group of experts that will be leading us today, and we'll have time at the end to hear to field your questions. So please send them in. We would like to hear to know who's in the group. So I think we're going to be sharing in the chat a prompt for everyone to go ahead and introduce themselves, share your name. I think it's your location and your company. We'd love to know who's around and where everyone's coming from, so that we can continue to build this community and support each other. So we'll be sharing that in the chat, and please do respond. Next slide. Great. Just going to give a quick intro and overview of our two partners, New Energy Nexus and Momentum. I'll start with New Energy Nexus. New Energy Nexus is a global entrepreneur support organization. Our mission and our high-level vision is to provide 100% clean energy for 100% of the population. And we do that by supporting clean energy and entrepreneurs and startups in their journeys. We all know that the clean energy transition is underway, and we're all about supporting entrepreneurs and startups to convene the necessary technologies and communities to ensure that that transition happens in an equitable way. You can see our core programs at the bottom. In California specifically, we are a global organization. We're representing our California organization, although we have chapters around the world in South Asia, Southeast Asia, Sub-Saharan Africa, and New York. In California, we're really focused on providing support to early stage entrepreneurs in our Cal Seed and Cal Testbed programs at TRL 2 through 7. And on the other side of the innovation spectrum, we're also working in career pathways with our Next Step program, which is pre-TRL. And on the other side with existing employers, really helping to set up really equitable employers in the clean energy workforce, and helping them work really closely with communities that they're embedding in. And since 2016, we've provided $45 million in funds to 180 startups, generating an estimated 500 green jobs and 130 patents. I'll go ahead and pass it over to Kula for Momentum.
Thanks, Elisa. My name is Kula Addy, representing Momentum in this brilliant partnership we've had with NEX and its programs. Momentum is a clean tech consultancy based in Sacramento. We design, develop, and deploy funding campaigns for solutions that make our world cleaner and greener. To date, we've deployed over 10 billion in funding through our core client work, and we've continued moving innovation forward with our family of companies that you see here on the screen, like Fuse, which is a platform simplifying access to low carbon fuel standard credits, Giraffe, which we like to say it's the turbo tax for the Inflation Reduction Act, and also Momentum X, our venture studio, which you'll hear from its founding director here in a moment. Before that, next slide, just a couple of quick reminders about the workshop today. We do encourage you to engage in the chat. It's great to see where some of you are from. I've seen folks from here in California and all around the world. We absolutely want more of that. For any questions, however, please, to ensure that we can get them answered, use the Q&A feature that's on the bottom panel. We want to get our panelists able to answer those when we come to the Q&A section. And with all of that, keep in mind that we're here to build community, foster solutions. So thank you in advance for maintaining that spirit in our hour together today. We'll also be recording so that you can get this in your inboxes afterward. Next slide. I am so honored now to introduce a dear colleague of mine, an old boss as well, brilliant thought partner and really the brains behind all that is Momentum. He is an architect working at the intersection of fintech for climate, founder of Momentum, and current founding director of Momentum X, your moderator, Shawn Garvey. Hey, Shawn.
Wow. Thank you, Kula. How are you?
Good.
Excellent. This is so exciting. I didn't get a sense. I think we had about 140 people register for this. So I want to start out, first of all, hello, everybody, by welcoming everybody and extending my gratitude for the work you're all doing. I'm watching the chat go by, and you folks are on the vanguard of this movement. You're doing the heavy lifting. And I'm very grateful that you took this time out today to have a conversation, engage in a dialogue about advanced financial management in the clean tech space. Having been doing non-dilutive funding for the better part of 25 years in clean tech, I've seen a lot of progress, but it's only in the last couple of years that I've really seen a sophisticated and serious conversation about expanding our capabilities in financial management. So this morning, we're going to have what is a veritable rock star. We can move off of my slide of panelists um, uh, who are on the cutting edge, just as you are, of innovating clean technologies, are on the cutting edge of innovating clean tech financial solutions. And so I'm hopeful that you'll come away from this inspired to think deeper about this, to engage in some of the new services and platforms that are out there, and to begin to leverage your financial capabilities in a more serious way. Very, very quickly, obviously, the title of this is Securing Capital and Advanced Financial Management, and learning how to move early stage startups to immediate cash flow. Our three panelists, Chante Harris, she's the founder of Eunoia. Sorry about that. She's a rock star herself of clean tech finance. She's a Forbes 30 under 30, and she has her own very, very recent experiences in developing new solutions for clean tech finance that enable us all to do our work better. We have Scott Pitts. He's an advisor and colleague to Momentum and to me, myself. And frankly, I'll just be honest with you, Scott was the first person in my 25 years in clean tech finance who was able to sit me down and communicate to me and my C team, my core team at Momentum, how to implement advanced financial management practices, how to manage cash flow differently, in a way that has significantly strengthened our organization, and allowed it to grow from 20 folks to 70 folks in a matter of the last 24 to 36 months. And then finally, Erin Davis. She's the co-founder and COO of Enduring Planet. I love Enduring Planet. If you haven't heard about Enduring Planet until today, you're going to remember them after this. They have developed a platform to forward finance grants, and recently expanded that to forward financing public clean tech contracts. So expanding beyond grants. They have a portfolio in excess of 40 companies that they've made investments in, and they've really entered the scene of clean tech finance and expanded the conversation in a really dramatic and revolutionary way. So I'm going to be quiet. It's 11:10. We're going to go right into questions. Thank you to the three panelists for being available today. Here's my first question, and I'm going to throw this open to all three of you. So if we get all three panelists on the screen. Just as the entrepreneurs represented on this call are pushing the envelope of software and hardware innovation, you, the three of you, are pushing that same envelope in clean tech finance. Can you, just as a setting for this conversation, can you talk about what some of those emerging advanced financial management solutions are and how you've watched them advance over the last 2 to 3 years, and what the prognosis is for the future? I'll just leave it open. Or maybe, actually, let me call on you. I'll call on Chante. Chante, would you lead us off?
Sure. Yeah. Hi everyone. Chante Harris, founder and managing partner of Eunoia Group. I just want to make sure I understood the question correctly, Shawn. It sounds like you're asking us to talk a little bit about how the landscape has shifted and sort of what options are out there for founders now. Is that correct? Okay, great.
Yeah.
So I've been an operator, an investor, an advisor. I've seen a lot of different stages of companies scale over the past decade, some of which had really de-risked the technology and the science, but hadn't quite figured out the market risks. And I think starting with that framing is really important, because when you're a founder, it really, really does matter, particularly in the clean tech space, what risk you are working towards mitigating, particularly as you're thinking about raising additional capital or, quite frankly, just accessing other types of capital. So I ran a venture studio for about 2.5 years that was launched in 2020, and we funded 20 companies over the course of 2.5 years. And so I sort of saw the whole gambit, right? We had software solutions, hardware solutions, many of which are actually a combination of both. And I think what we're seeing more and more, particularly now, I think the discourse is more mature than what I saw even a few years ago around, hey, if you are hardware, you most likely have a software component, and that matters, or at minimum, you have something that can be leveraged into software, because I think that's where we start to get into this conversation around revenue and cash flow. If you're a capital intensive technology and you're still in the lab, you're still testing. We had a number of founders that worked with NREL and spun out some of their IP into climate tech solutions that were then backed by angel investors and VCs. It wasn't about, hey, is your product going to be fully de-risked in order for you to gain access to additional capital, but it was about how are you thinking about revenue streams up front, which I've, from my experience, found that many clean energy entrepreneurs don't do. So they sort of wait until they have a product or a prototype and they're like, hey, we have this thing, we've done all this great science, we've built all this great technology, buyers, please come and pilot this, please come and pay us to use it. But obviously, because it's still new, there's a level of risk that you're asking both funders and your most of the time your customers to also take on. So what I've seen is an ability to say, hey, how do we actually apply some of the initial value that we have that is separate from the technology itself? So that might be insights, right? As you're building your solution, maybe you've come up with a new type of polymer alternative and you want to sell that into different industries. What have you learned in that process of testing that might even be both accessible and interesting to corporate innovation arms? And I think that's when we start to see, hey, revenue is probably going to come from two different parts of the business, but both of them have to work in conjunction with one another. So I think that framing is important to name initially. And then, I think the big elephant in the room, at least not as much anymore, is grants. I think for a long time, we sort of knew about grants. Folks would talk about grants, the investor community, not as much. But grants have single-handedly been one of the biggest, aspects of financing solutions in the clean energy space for a very long time, even before this recent climate tech boom. $70 billion of climate tech venture capital was earmarked in 2023, which was both exciting, but I think many times what our space doesn't do well is actually aggregate and track the amount of non-dilutive capital that is going into these companies. So the venture studio we ran, or I ran alongside my co-lead and my team at the time, we actually were taking public-private capital, merging that into a blended finance model where it was non-dilutive, right? And so that allowed companies to actually build their prototype, sort of go from science project to real business. And what you see is this really nice de-risking of not just the tech, because I know we'll talk a lot about the technology and the science, but where is that technology actually valued now in the market? So you might have an alternative, you might have something that still needs to reach price parity in the future, but who's willing to pay for that now? Who's already paying for whether it's the insights or the prototype or the testing now? Maybe they're doing that in-house as well. So I'll start there. Obviously, I'm sure we'll have lots more to chat about, but I do think the framing around what risk are we talking about, particularly at the early stage, and what are the types of capital that align with those risks when you're thinking about your fundraising journey, but also your cash flow, because you may not have cash flow in the first couple of years of building. You might just be putting it towards the R&D and the testing, particularly if it's a hardware solution.
Scott, you want to pick it up from there? Thank you, Shawn.
Sure. Yeah, those are all great, great thoughts. Most of my experience in this world has been in the slightly later stages where things are being deployed. And in terms of answering this question and sort of alternate funding mechanisms, one of the things we focused on was how can you infuse capital into the company without traditional debt or relying on future revenues to pay back the money or on the equity side. So, for example, one alternative is to use financing for specific things that you would otherwise have to put out your own cash for. So in one case, for example, we had a client that was a smart campus offering where they were putting in all kinds of new equipment and thermostats and, all controlled by a centralized system. But they didn't have the capital to buy all of the equipment and get it in there. So we ended up doing a deal where the financing partner actually bought all of the equipment in their own name with their capital, and then essentially resold it to the startup, and was paid back plus their financing fees as those things were put in place and the invoices were actually paid by, the end customers. So things like that, where you can find creative solutions, particularly where you have collateral, right? So it's not that my financing company particularly wanted to own several $1 million in thermostats, sitting in a warehouse somewhere. That was something that we knew that if things went very sideways with the startup, we could get our money back, right? And that is one of the real keys. So when you find that you have an asset or you need something that has real tangible value, you can often leverage that into getting some capital into the business without taking on more debt or equity in a traditional sense.
That's interesting. Scott, would you take a moment just to elaborate on how a startup would begin to have that conversation?
Well, I mean, obviously the first thing is to find people who are open to that, right? And so in the clean tech space, especially in the last few years, what we've seen is a proliferation of non-traditional entities out there that are looking to get involved. They're looking to be part of the solution, whether they're family offices or small groups of individuals that have pooled funds to sort of do something in this space. So outside of the VC community, outside of traditional debt providers, there are lots of individual groups, I think, that you could leverage, but finding them and finding people that are particularly interested in what you are doing is really the first step. So one of the things I hear anyway in this industry is one of the keys to some clean tech startups is finding lovers with money, like people that love what you're doing and also have some money to put to work. And so if you can marry up that strong interest with somebody who has capital that they're willing to sort of risk to get a return, then those are the relationships I'd encourage people to start cultivating as early as possible.
Thank you. Erin, what's your perspective on this?
Yeah, I have two hats to wear in this conversation. I think one is being a startup founder myself, and having raised some equity. I think a simple mechanism, for the sake of completeness, and I don't know if this is too basic for everybody, but I just want to mention safe notes, simple agreements for future equity. There's a simple template that Y Combinator has for the legal docs, and it's just a great way to raise equity capital in a non-complicated way. And then my other hat of investing into climate tech startups, and I really want to highlight a word that Chante used, which is non-dilutive, where we're all about companies getting non-dilutive capital as soon as they can. I think considering the weighing the pros and cons of the cost of equity versus the cost of debt. Obviously, some debt mechanisms are going to be pricey because you're an early stage startup with not a lot of collateral, but it can really be worth it in terms of the trade-off of dilution. So some Some things that we have tested out at Enduring Planet is revenue-based financing. To be honest, it was a mixed bag. We were testing out applying RBF to different types of business models. We don't do that type of lending anymore, but I wanted to at least mention, if you are generating monthly recurring revenue, that could be an option for you. And then, you have to consider the overall pricing of that and watch out for the additional fees that sometimes RBF lenders like to put in there. And then I think, for my personal plug, so we're funding, advancing companies that have won grants. So we are looking at, we've funded companies of one person who have won, California Energy Commission, like startup grants for 50K. But essentially, we're just taking, collateral on those future receivables of the grant that you do have in hand. There's, a challenge with a lot of these grant programs. It's like, well, how do I get started on the work if I don't have the capital? I applied for the capital so I could do the work. So we're trying to address that challenge. And then similarly, Shawn, as you mentioned, the kind of invoice factoring, we're starting to dabble in that. And there's other firms out there that are doing that.
What, just as a follow-up to that, Erin, for a startup that has been notified that it's successful with a small or large grant, what's the first part of the process? Like, what do they need to do in order to approach you with seriousness? What needs to be in order? What do they need to be prepared to do and think about?
Yeah. So we're very happy to establish a relationship, get to know you. If you have that public notice of award, but don't have a contract in hand, we're very happy to start our sort of underwriting process to be ready to fund basically the next day that you sign the contract. So we have a simple application process. You go to our website and apply online. The application takes about 10 minutes. And what you should be prepared for, and also, hopefully we'll talk about this later in the conversation, but what we're looking for is, a history of your banking transactions, no matter how long or short. We're looking for a pro forma kind of forward-looking model, how you're, thinking about your cash flows and planning for the future and how you're going to pay for this grant project. And that's really the bulk of it. We rely a lot on the award proposal, the award contract, and the budget to then get you a term sheet in a week. And, upon signing and successful diligence, we can fund in 30 days.
Wow, that's great. Thank you. Thank you for the elaboration on that. I think you also mentioned SAFE, and just from my personal experience, I know there are a number of platforms out there that manage the SAFE process, but Carta is certainly one of them, and their launch program, which is free to startups if you're not doing your cap table management using a service. The launch program in Carta is free, and it does, for free, I believe, manage safe note issuances for startups. So that's one resource that folks should be aware of. Chante, I'd love to turn to you. And I'd like to just explore with you some of the specific challenges. You discussed them in your opening remarks that you see out there that climate tech startups are experiencing. And some of the specific challenges you've seen those startups face, and tactics and strategies around finance that you've seen them successfully deploy.
Sure. Yeah, there's a ton of challenges. I'm sure you all are living through them now, but I can list a few. I think it's no secret that the space is capital intensive for many reasons. We talked a little bit about that earlier, but most of these solutions that you all are building is not just software. And even if it is software, it oftentimes is interacting with the built environment in one way or another. I remember seeing a tweet from a founder probably a couple of years ago that said, I can build software solution for solar management, but if there's no solar projects, I don't have a pipeline. And so there's still this reality of many solutions that are software based, still having to think about the capital intensity of assets, like real assets that are going into the world that many companies are building and deploying. I think other, large risk or, large unknowns when you're building a company in this space are technical uncertainties. So I've seen multiple examples of, an IP feels good, looks good, national labs have signed off on it, but that doesn't translate necessarily to the application that the company is looking to jump into, or when they do jump into it, they come across specific challenges related to the science, or maybe something doesn't quite work right and they have to take it back to the lab and update it. I think particularly at the early stages, you see that the most. I think other hurdles include regulatory hurdles. It's one of those areas that, again, I think hasn't been looked at as much, but there's a really great fund called Overture, and their whole thesis is how do you really think about procurement and regulation as a driver for deployment of solutions rather than what I think it has historically been labeled as, which is, no gov tech. We don't want to touch gov tech. It's too slow. When the reality is that most clean tech startups, even if you don't define yourself as gov tech, you're going through some level of a government interaction to get where you're trying to go. So it really does behoove you upfront to at least have a minimum understanding of what some of those regulatory processes and challenges might be. Market adoption, which I alluded to earlier, not just who you're creating the product or the process for, but who's going to spend money on it, right? And who's also started to think about earmarking money for that specific challenge that you're solving. And if they haven't, how do you do that at the early stage, or how do you start to create that opportunity for them to look at really earmarking money for whether it's pilots or full on integration of whatever you're building into their operations. And I think a lot of people do tend to overlook that, again, as I said, sort of wait until the product is built or they're ready to deploy into a project, but they haven't really done that legwork to understand what's driving their customers, right, and the market adoption. And I just remember from my own experience working with founders, a lot of times because you're juggling a lot, many founders will sort of gloss over or try to speed by the customer market exploration, and just don't do that, because I could probably spend all day giving you examples of founders that have come back to me and said, hey, we should have spent more time here in terms of customer market exploration and making sure we had product market fit before we maybe built out a full application for a specific solution. And then supply chain's a big part of this. I feel like, that's alluded to in market, but supply chains are complicated for those who work in supply chains. And what we're talking about in climate is really an upgrading and a sort of next generation of how supply chain is going to be managed moving forward and globally, right, on a global scale. And then talent acquisition. I know there are a ton of startups that have popped up over the past few years that are really focused on ensuring that we close that gap in terms of talent. Like, how are you ensuring that you have the right players on your team? Do you hire a policy person at your seed round, particularly if you're going to be facing regulatory hurdles, so you're not wasting a ton of money on consultants that might not actually get at the goals that you have, which I do see a lot of in the climate space. I think there's a mismatch and a lack of knowledge around what team members are needed oftentimes when you're going from R&D to full prototype. And then in terms of potential avenues to ensure that there is revenue, to ensure that you do have funding, we've already alluded to this, but I'll always think hats off to the Enduring Planet team, and particularly what they've created on the government grant side. It's really critical. As someone who's helped secure millions of dollars in government grants, it's not just the securing of the capital, it's getting access to it, which can take a long time if you've ever worked with government. So as much as I was saying a second ago, you're going to interact with government, remember that, and also be prepared to think about, okay, if and when I get this contract, where is that cash flow going to come from so that I can actually execute on it? Because most contracts, you won't get that money up front. I will say one of the loopholes or things that have worked in the past for me and working with different solutions to scale is, particularly if you're a subcontractor, you can actually negotiate that with a prime. And most of you will be a subcontractor starting out. So it is important to think about what those terms are when you sign the dotted lines as a subcontractor. The prime should be responsible. Quite frankly, many of them are getting extra points for working with the small business or more innovative solution. So really look at it as the time to negotiate and ensure that you're getting what you need to be able to deliver on your side of the scope. And they should know that, or you should ensure that they know that because you are smaller. And then I think one of the other mechanisms that I've been really excited about over the past few years is crowdfunding. Crowdfunding has played a big role, especially for deep tech companies. And I think particularly when you think about B2C plays within climate, many climate tech companies have a B2B and a B2C play. Crowdfunding can be a really great marketing tool, but also a way to get your customers galvanized while having a stake in what the outcomes are. And then I think some of the other things that I already started to allude to is partnerships in this and talent. So who are you working with? So academic collaborations, corporate partners, you should not be doing everything in-house. And I think that's really important to name as you scale. There's a great graphic from Bessemer Venture Partners that shows the gap, particularly that second valley of death, which I've done work in as well. I know Scott alluded to this. Series A to Series B is where we see most companies drop off. And one of the main indicators is revenue. And so if you don't have a significant revenue increase, you're almost 100% likely to not succeed. So you have to be thinking about revenue. You particularly have to be thinking about revenue as it relates to pilot projects. And one way to do that is to think about how to take more things off your balance sheet. So who will provide asset-based lending? Who will provide, leasing of equipment at no cost to you or little cost to you in terms of fees and interest? I know I think it's Camber Creek Road, if I'm not mistaken, they do equipment and other types of machinery leasing on behalf of startups. They've been a great partner to many founders that I know. I can keep going, but I think you get the gist of ways to think about hurdles, but then also how to think about really cutting the cost, because really before we get to questions of cash flow, it's also how are you applying that capital now? Because I would say 3 years ago, when there was a bigger valley of death at that R&D stage, folks were more likely to provide capital for pilots and things like that. I'm not seeing that same level of interest because most players outside of venture capital are assuming you're at least using some of that equity, or you've secured non-dilutive capital to get those pilots off the ground. So I would really, really encourage you all, as you're thinking about your early stages of pilots, that you're really thinking about how that money is going to successfully allow you to show a proof of concept and get through that pilot stage.
Wow, great. Thank you, Chante. That was an exceptional overview of the space. I loved that. Thank you. Scott, could you elaborate and go a little bit further down the path? And frankly, I'll just hand this up to you in full transparency. Scott and Socket Capital started working with our startups at Momentum a number of years ago and really retrained us from a very conservative approach about our receivables and our cash on hand to a much more aggressive approach. And it fueled our growth. We would not have grown at the rate we've done. We would not be the successful company that we are today in quite the same way without Scott. So Scott, tell us, and you can use us as an example if you want, or use a third party. How did you go about doing that? What were some of the pitfalls that we foresaw at that time? And then how did we overcome them?
Sure. I'll try to keep it brief. And hit the highlights, but essentially, one of the big issues we see once people get in market is timing issues, right? You need money now to buy your inputs, to make payroll, to hire ahead of revenue, all of those things. But you may have sales, you may have invoices out in the world, you may have purchase orders for your goods, but that's not cash. And so solving the timing issue is often a really critical part once you're actually sort of up and running, so to speak. And so, as Shawn mentioned, that's been one of the critical issues in some of the startups we've worked with together, in that a lot of their, you know, they've done the work, they've delivered on goods, or they have orders that to be paid upon delivery, but it's that timing issue that's a problem. So in that case, what we've done is implemented fairly traditional financial tools, just utilizing some nuances for this industry in particular. So broadly speaking, those are things like establishing a working capital line of credit that is based on your underlying assets, which can include invoices and sometimes even purchase orders. So you can basically convince, again, lovers with money are the easiest targets here, to convince them to pull that money forward in time for you so that you can use it today in order to then unlock the value in those orders that just need to be delivered, or just wait out the time period while you're waiting for an invoice to be paid. And so in order to do that, the pitfalls we see for people who are looking to solve that problem, the big issues we often see are people just wait until it's too late, right? They don't have a great understanding of what the cash needs are. So oftentimes when people look at QuickBooks, or you look at your sort of traditional financial statements, you have a bunch of revenue booked or orders booked, and it can feel like the company is really being successful because you have a lot of people saying, yes, we will pay for this when you deliver it, or thank you for delivering it, we'll pay you in 3 months. And so often when you're looking at your P&L, you see revenue and expenses and it looks fine, but there's no money in the bank. And so being really clear on your cash position and having a high fidelity cash forecast, so you know when you're going to have a crunch, and getting ahead of that so that you're having those discussions with enough time to actually get a deal in place. I can't tell you how disappointing it is when a great company shows up and says, here's the business, it all looks great. And then they say, but I need a bunch of money on Thursday of this week, or I'm not going to make payroll. And there's just not much anybody can do at that point. So I'd say make sure you have that in place.
Yeah.
And part of what that causes, and this was really what Shawn was alluding to, if you only manage your business based on the cash you actually have in the bank, it can be really limiting, right? You have a capacity issue. So that was one of the issues that Shawn was talking about. The way they were managing the business, it was just capped in terms of how much capacity they could bring on. And so by solving the timing issue and putting some of those financing tools in place, it sort of unblocked that particular issue so they could go ahead and start growing.
We'll be forever grateful for that conversation. Scott, thank you. We're going to morph in about a minute into Q&A. Before that, I want to go to Erin and just get your feedback on and your input on general advice for the startups on the call. If there are some resources out there that you've come across that can help facilitate and accelerate their efforts, and then we'll move into Q&A. And folks can feel free to begin uploading Q&A of any type. We've gone so like 1 inch deep in a very, very deep conversation. But hopefully it's getting people inspired to think about. Erin, over to you.
Yeah, I again, from a very practical point of view, I think like having your books in order, I think it's sort of like a low-hanging fruit, but makes you appear much more mature and prepared for a fundraise. And they often get, more complicated and become more of a headache the longer you sort of push it off and ignore it. So I think, keeping your accounting in order, building a pro forma from the ground up, kind of taking a bottom up approach, instead of like just top down, sort of like, here's the addressable market, this is the percent I'm going to capture, but rather like a defensible model where you're saying, okay, like here's my lead gen mechanism. Here's how I call the funnel, and like this is how I'm actually getting to these projections, I think is a very defensible model. I think, hiring the right people, obviously, like that is so hard. But just really drilling in on your values and getting into business with people who share values. When my co-founder and I were deciding to start Enduring Planet, I was a very new mom, like 3-month-old, and it was like breastfeeding on a call with him. I was like, I'm just gonna tilt the video up, okay? And like he was totally supportive and just kind of, it just like gave me that sense of like, okay, this is the kind of people I wanted to, build a business with, because it really is like your co-founder, your first key hires are become, almost like family. So those would be my top ones.
Great. Thank you, Erin. As all three of you were talking, I had a couple that rang through my mind that are worth mentioning. Obviously, probably most folks on the call are familiar with and eligible for the applied RD&D credit. Hopefully everybody is familiar. And if you're not, the resource we use is Main Street. There are a whole bunch of platforms out there that do applied RD&D credits. They were expanded to $500,000 under the Inflation Reduction Act, and you can forward finance those through Main Street and through some of the other platforms out there. So that's another way that we have created short-term cash on a tax credit that would be available to us, longer than a year from now. Similarly, there's a rapidly advancing ecosystem of financing and forward financing the tax credits themselves under the Inflation Reduction Act. So there are a number of platforms out there. Obviously, we have one that we've helped develop called Giraffe, which has IRA in the middle. It's the only animal with IRA in the middle. That's our claim to fame. But part of the solution there is forward financing Inflation Reduction Act credits for electric vehicle and electric vehicle infrastructure deployment. So there's an emerging class of forward financing platforms out there for tax credits, for Inflation Reduction Act credits, for R&D credits, and then also for an asset base that a lot of the companies here have, but haven't really monetized, which is clean fuel credits, low carbon fuel standard credits, renewable energy credits. Again, a rapidly maturing space of platforms out there that will finance future LCFS and renewable energy credits that are generated by a project. So it's just something that came through my mind at the last minute. I think I saw one question so far from Weldon. Is that right? Where did that go? Anyways, I just so you guys know, I'm not seeing the question. I checked the Q&A box. Oh, there's a Q&A box. I'm sorry, I didn't see that. There we go. Thank you guys for tracking me in real time. Here's a good question. This is Scott mentioned that we should explore working with levers meets funding profile of investors. What are some signals we should be looking for in identifying the levers from the non-levers? This is a very deep question and could go in a lot of different directions.
Yeah. Yeah. Well, I mean, I think my advice would be, sort of the same with everything else. It's networking, right? Start talking to investors in your space, see if they know folks who are sort of on the periphery that they've worked with or seen involved in other companies they've invested in your space. The incubator programs and other folks who are really in the business of connecting young companies to alternate money. There's a lot of value in those. I believe they've built networks already. So try to leverage some of those sort of one-to-many kinds of node type relationships where you can get in with the folks who run the incubators. They have already built a network of folks that you can potentially leverage. And just being out in the world, with your social media, with your online presence, going to the conferences that some of these folks will attend to find new opportunities. But again, it's really about finding and building that personal relationship in a way that you know especially doing it in the early stages before you actually need their money, right? Developing those relationships ahead of time before you're hitting them up for a check is really critical. But there's no magic bullet. There's no, Craigslist for funders of clean tech. It's about getting out with your network and expanding that, I think.
Maybe that's a potential solution that somebody wants to create out there in
Right.
the startup world. That knitting together these ecosystems of platforms and services is something that hasn't really been taken on. So anyways.
Yeah, I think to that point, one source or resource that founders can look at is the climate finance tracker. I think it's actually the first effort to track, where climate funding is coming from across all these different groups. And I think it's important to say there's not enough transparency. Like I know we oftentimes encourage founders to use their networks, but obviously networks vary significantly based off of, where you come from, what you have access to already. So I do think, at least where I sit in the ecosystem, a lot of what we're trying to do is increase that transparency, so that folks can actually access, right? Whether it's, I'm sure you guys have, if not, you should look into it. Heard of Creo Syndicate, which is one of the largest syndicates of families that will make huge investments into hard tech climate companies and have been doing that for over a decade. I feel like they sort of came back out into the public in the past few years, but they've been around. I think the families within that organization that they oversee have over $1 trillion under management. So that's a great place to start. And I'm not going to pretend like the outreach there is easy, like they have some sort of intake form, but I do think it's important to know about. And to the extent that you can leverage your network to get in front of players like this, that's important. And the climate finance tracker, like I said, that's being built and updated consistently by an incredible group of data scientists who really care about this transparency question and helping founders not only get funding, but ensuring that funders are deploying into the areas that we need the most within climate. So highly recommend looking at that. It's a free resource. I think it's on Impact Alpha, if I'm not mistaken. And they might even have their own website, but both of those resources I think are good places to start.
That's
one other
brand
thing
new
I
to
would
me. Sorry.
one other thing I would just throw out there would be we've seen a bunch of folks have success with local angel investor groups. So and often there's this combination of I'm a lover of clean tech, but I also want to support my local companies in those angel groups. And so they have lots of gatherings of these, usually high net worth individuals. They make investments as the angel group, but it's also just a great way to meet those individuals so that you can build relationships and do one-off deals. So I'd recommend that as well.
Thank you, Scott. That's great, and thank you for that climate finance tracker, Chante. That's brand new to me. I appreciate it. That looks like a great resource. Weldon Kennedy is asking, to address climate change, we need to retire 1 billion fossil fuel burning machines. Most of these are owned by consumers. How would you design a working capital debt stack for companies making and selling clean electric machines to consumers? This is a pretty specific question. But if there's any folks who have a perspective on that. That one sounds like an extended sit-down conversation, actually. Maybe a future next conversation based just on that.
Just take a little stab at it.
Good. Yes.
I mean, I think obviously it's totally depends on all the caveats and all the things, but what we see is, is definitely a combination of a capital stack. So, like starting with, your angel investing, some VCs coming in with some early equity to kind of like build a prototype. And then, you could leverage the DOE program. I think it's called the benefit program. I'm not totally sure on like what stage that you need to be, but I'll drop the link in. And what's nice is that the grant awardees are publicly available. So, and I'm sure some are even on this call today. You could pick their brain, just ask for 15 minutes of their time and see, what they did to build up to winning that award. I think that's just like so helpful again to leverage your network. I can't paste the link to everyone, but I'll put it so somebody else could paste it. Thanks.
And I'll just add, I think a good example is actually Keyframe Capital. They did a virtual power plant facility, I think last year, with a company called Logical Buildings, which is smart thermostats. And so this question of, how do you incentivize the consumer while also needing to, essentially deploy, right, whatever your product or solution is at scale. They raised, I think it was $110 million specifically for creating that incentive for the tenants within buildings and then also the property owners. So there are examples of like creative ways that folks have been and are starting to do this more. And I think in light of all the virtual power plant conversations, especially when it comes to distributed assets, we're going to see more and more of that across the board. So I would definitely take a look at what players are already doing that, where there's an opportunity to scrub, how that has been structured or what that looks like, or even reach out to those teams, especially if you're early and you haven't yet thought about that, or you don't need to think about that in the same way. I think to Scott's point earlier, like build the relationship now, say, hey, this is something we're thinking about as we're scaling. We'd love to, connect with your team and hear more about how you guys might do other facilities like this, and if there's an opportunity for our specific category of technology.
Thank you, Chante. One of the things that we're quickly coming to the end here, Sonia Davidson's asking about federal funding and the lag in federal funding. It's a very long, it can be a long process. Although I have watched over the last several years, it become shorter and more transparent. Sonia's asking if there are people inside climate that could help or accelerators out there. I know we're being hosted today by probably the premier entity, New Energy Nexus, and that would be where I would start, frankly, is with the host of this call. I think in the interest of transitioning to back to Kula and Elisa. Does anybody have any wrap-up things that weren't said, Chante, Scott, Erin, that you'd love to just leave an impression, a last impression?
Yeah, I just want to mention Trellis Climate, which was spun out of Prime Coalition. They also have Azola Ventures. I think they're a really great example of a team that's innovating in the finance space, particularly for hard to abate technologies. But I worked with their team on Trellis Climate last year. They announced it this year. And what they do is provide recoverable grant capital to founders for pilot projects, particularly the pre-development stages. So things like feasibility studies and environmental assessments that can get pricey, especially when you don't necessarily do the process correctly up front, which talked a little bit about the importance of, the right team and talent there. But I think it's a really great example of how catalytic capital and other types of capital are starting to emerge, at least the application of that capital differently, which is exciting. And so if you are thinking about your first pilot or demonstration and you're not sure about the capital stack in your own company at the moment, that might be something to look at. Most catalytic capital does want an impact angle and requires that in order to invest. So you have to not only think about environmental impact, and that should, you know, your LCA should be in order. You should have some numbers that make sense, but then also social impact. And so, you know, as you build your company, you're constantly you know, thinking about and weighing which types of funding works best for you as you scale. But do you think catalytic capital is important to mention, and Trellis Climate is a great example of that.
Thank you, Chante. Scott, Erin?
I would, yeah, the only last thought I would leave with everyone here in terms, you know, starting and then growing these young companies, I would just say, remember that your plan A is only as good as your plan B. So be prepared for plan A to go sideways at some point during this journey. Make sure you understand what that will mean to you and how you can recover from it, whether it is, you know, figuring out how you can reduce your burn to zero essentially while you get more capital, or, you know, pulling in capital in creative ways to fill gaps. But just count on something going wrong that will cause a capital crunch at some point, and make sure you have a backup plan in place so that things don't fall apart.
Thank you, Scott. Last word, Erin?
Yeah, I would say, you know, reiterate just having the basics down. You know, having like if you're going out to raise money, having the different components of a data room ready. There, I think we'll be sending and follow up some resources, but on Enduring Planet's website, we have an insights section, and we talk about how to build a pro forma, how to build a data room, talk about first of a kind funding. We just interview experts in the space, and I would definitely recommend checking that out.
Excellent. I want to thank all three of you, as well as the questions, but I really want to thank all three of you for the work that you've been doing for years now to help facilitate finance for all of these clean tech innovations. Really, from the bottom of my heart, my gratitude is to you. Elisa, did you want to close up?
Yes. Just reiterating gratitude. We have 1 minute. Thank you so much. Just such an incredible first ConNEX panel and workshop. It's setting the bar super high, which I love. I also wrote down my key takeaways: finding lovers with money. I love it. Thank you so much all for attending. The chat was exhilarating. So incredible to see so many startups and entrepreneurs that we've supported through our programs and then beyond. We are going to be doing this every other month. Our next session, our next workshop is coming up September 12th, same time. We all know that building diverse teams is critical to supporting the just energy transition and supporting the communities we're working with and for. So we'll be talking about that, exploring different dimensions of diversity. And then the next one in November, we want to hear from you. It's critical that these are very value added for you. So if you could take a minute, literally 1 minute, we have one required question in our survey. We'll put it in the chat now, and we'll send it in the follow-up email. That would help us a lot to plan these in the best way possible. And we will send out the recording, the resources and notes, and I think contact information or ways to be in touch with our panelists in the next few days. And please send any feedback in response to that email. Thank you so much, and have a great rest of your day.
Thanks, everyone.